Okay, everybody, so welcome. We're going to get going. Welcome to Finding the Perfect Storm. Tonight's going to be is very exciting for me to talk about with you all. I know there's some people I've in the group here we've known for a while, and some of you are new. But for any of you, whether new or not, this is one of the most valuable things over my 12 years of trading that I incorporated. It made a big impact on my success as a trader. And the most exciting thing when you're trading is to get to a point where you look at a chart and you feel in control, where you are excited every day to wake up and see if the stock's done exactly what you thought it would, versus trading the market because you maybe know you've done something silly and you're just hoping it doesn't hurt you, and inevitably it usually does. So finding the perfect storm is all about developing consistency and strategies to help us in whatever our goals are. And, of course, the standard disclaimer that goes with any kind of financial workshop. Just have that up on the screen there for you. All right. So just a little bit of an introduction to Acorn. If you don't already know who we are, Acorn Wealth was actually founded in 2007. We're a small group of traders, myself and about 4 others, and we just did full-time trading. It was what I had been. I've been traveling for quite a while, using that as my income mechanism, and we finally just decided to start a group where we could combine trading ideas, and we were focused mainly, well, almost primarily, on the technical side of the market. So looking for price and volume and things to tell us really where the high probability moves were next. It was through these strategies and some of the things I'm going to be talking to you about tonight that allowed us to identify the crash of 2008 coming very clearly on June 6, 2008, as well as the fall in the market of 2010 and in the months leading up to the EU crisis. And we are getting some very interesting signals once more now. But we are recognized as one of the leading firms in North America. We've been featured and lectured at many of the local universities and nationwide. And again, all of that success has come back from having some specific strategies and ways to approach what's going on. So where are we? Well, firstly, before we start going too much into questions about the world, I'd just like to throw a few questions out to those who are in here right now. How many people here are novices? How many people would consider themselves intermediate or experienced? Maybe, I mean, you can send it to me privately, or you can share it with the group if you like. How would you rate your own level of experience right now? I'd love just to always like to get a feeling for the experience levels of the different groups we work with. Experienced, novice, new, not sure. Fair enough. What's a stock, says Kyle. Very funny. Okay, so yeah, I mean, one of these things, I think that the purpose of tonight is that whether you are novice or experienced, this is valid for everybody, because I've sat down with a trader last week who's managing 15 million in his collective portfolio of the money he manages and his own, and even he said to me that he still struggles with being able to have the level of consistency every month that he's looking for to take his fund to the next level, and it's often the same things that people are experiencing problems with. So again, let's go back to having a look at where we're at in the world. Where we're at in the world is we have central banks pumping money into the economy with no end in sight. We bailed out the major banks, but what about the investors? Are we really creating economic growth, or what? So has the rally been in the market based on true economic activity, or is it just another bubble? And there are some scary things if you look at some of the sectors, the healthcare problems which could come out of the Obamacare, and I'm not a pro or negative on that issue. I'm just telling you what the technical is showing us. We're at all-time highs on the S&P 500. There's optimism among market players. The big leaders has been the tech sector. You know, the Yelps, Splunks, Facebooks, things like that. But not tangible brick and mortar, but actual you know, speculated value. So again, is the market building towards the top of another bubble? Well, if you look at the likes of Danielle Parks and her book Juggling Dynamite, she would say yes. I think it's estimated at $4.3 quadrillion of speculated value in the exchanges. Now, if you want to know how much that figure is, that's essentially all of the world's real estate added up. Doesn't equate to the amount of speculated value in the economy. So not real value, but potential future value sometime. So that's a lot. That's a lot of leverage. Again, not trying to scare you, but what is your plan with all of these things in play? What is your plan going into the debt ceiling that with the U.S. is constantly fighting? And how will we maximize opportunities and protect against loss? So here, those are some of the key things that we want to ask ourselves, and of course that comes back to what did we learn from 2008? Have we changed since then? So again, what type of investor are you? I'll put another question back to you. For all those people who are of different level of experiences, how many would you say of you are day traders? How many swing traders? How many long-term investors? Just maybe if you can give me a bit of feedback. I'd love to get an idea of where everyone's kind of swing, day, okay? A lot of swing trading. That's perfect. That's mostly swing, little day. Okay. That's excellent, because that's what I do. That's what I do best. That's what my favorite is. So the reason why swing trading is so powerful is it's all about having a exact strategy. A long-term investor, you know, these are big picture stuff. People say, well, I'm going to follow what Buffett does. Well, that doesn't necessarily work, because Buffett's buying billions and billions of dollars of stock at discounted prices. If you buy 1 billion PlayStation 4s, you're going to get a price better than the guy who buys one. So Buffett has an immediate advantage. He's also getting you know, control of the companies in a lot of times. He's getting dividends that others might not be getting. So when you look at long-term investors, they're on a completely different playing field. You look at day traders, well, that's the other extreme. That's where you don't care at all what the long-term picture is. In fact, you probably don't even know what the company is that you're trading half the time. It's just purely in and out in times as much as a few seconds. And it's pure price. And then, of course, and that's very work intensive. You are still working for your money as a day trader, because your ability to make money often is dictated by your ability to sit in front of the screen on particular hours. And my feeling to that is that whenever you have to be whenever you have to be doing anything at a specific time for a specific amount of time, it is still a job, even if it's very highly paid. And that's why I don't look at day trading as my primary source. I still love day trading for the fun of it. But my objective as a trader, what I've specialized in for the last 10, 12 years, is swing trading. And the idea of swing trading is to really kind of have a setup where we can set and forget. So, but all of that will come back to what your investment objectives are. You know, are you investing for time? Are you investing for toys? Maybe you have plenty of time. Maybe you're already retired, just want to be buying more stuff. For me, most of why I started trading was to travel and to work, not from home, but to work from anywhere I want to work, which ties in with traveling. To me, trading isn't about making millions of dollars. To me, personally, trading is about being able to make money from anywhere, because you could be making $150,000 a year, or $250,000 or $450,000 a year, working 100 hours a week in Vancouver, Chicago, New York, whatever. What good is that money if you can't be on a beach enjoying it, or on a golf course, or with your family? So for me, trading is about freedom, not about the millions of dollars, so to speak. It's the value of your time, the quality of what that provides you. So that's why I like swing trading. It doesn't make the most amount of money. Day trading by far makes me the most, but it is the most freeing. So again, if there's anything specific that you look for as a trader, that's obviously what you want to incorporate into your strategy. Now, let's have a look at how most people make their decisions. So most people make their decisions through news, friends, tips from friends, newsletters and brokers, or maybe things that they're familiar with. Does everybody, can anyone here kind of assimilate with that? How do most people here make their decisions? Just to throw in the chat box, how do most people find a stock that they're looking to buy for the next day? Is there anything consistent that people look for? Fundamental and technical? Volatility, watching the stock market, okay. So one of the things we want to do is whatever we're doing, we want to make it consistent. A winning trade is only winning if we can replicate it. And a loss is only a loss if we don't learn how to avoid it next time. As somebody said to me last night, I was actually watching the Canucks game, and I was sitting next to a lady who had hosted a Halloween party at her hotel. And it was the first time her hotel had put on a big party like this. And I said to her, I said, well, I heard about that in the news. I said, so are you ever going to host one of these things again? Because it sounded like it was a tough experience. She said, I never quit. I only get better. So of course we will. And I thought that was an interesting attitude. Same goes with trading. We have a losing trade, never see it as a loss. See it as an opportunity to learn. The reason why most people don't learn is because they are constantly making decisions emotionally, which is what leads us to these mistakes that you can see coming up on the screen here. So you've got averaging down, buying into emotions, selling on pullbacks, basically taking too much risk, investing emotionally, lacking a strategy. And this is why we have this, because we have constant distractions. I'm going to show you here tonight how to start avoiding this. Because here's the most important question I want to ask you all. And this, as you can see up on the screen, this is the most important thing. If you could sit down with a pen and paper and draw exactly, and I mean exactly, what the perfect chart would look like, what would it look like? Do you know what it would look like? And secondly, if you were then going to sit down and write down exactly what the criteria or conditions would be, what would those be? Because if you really want to be serious about your money, and why not? You know, why not, if you work 40 hours a week to make 60 grand or 100 grand or 200 grand a year, whatever it is, doesn't matter. If you work 40 hours a week to make your income, why not give the same level of attention to detail to being able to enhance that by spending an hour longer? I mean, if your employer, if you work for someone else, said to you, if you work 1 hour a day longer, I'll increase your salary 50%. Would you do it? You probably would. I hope you would. If you work for yourself, if you figured a way to work 1 hour longer in your business or employ one more person to do that for you, and you could increase your business's revenue per year by 50% or 100%, you'd do it. So how come we treat our income and our jobs and our careers so differently to how we treat our portfolios? Because a properly managed portfolio, one of the traders that I work with, he's a full-time trader, and for the last 3 to 5 years, where he's been part-time and full-time trading, his average results have been from 40% on a bad year, I think 30%, sorry, on a bad year, to 100% in a good year. And that's how he makes his money. He's a full-time trader. That's the potential. Now, not everyone will get there, but that's the potential. So why not start looking at it as such? Why not treat it like a business? So in your business, what opportunities are you looking for? The problem is that most people don't know. Most people do not know exactly what they're looking for, and so anything will do. As I said, if you don't know where you're going, any road will take you there. But think of it this way, again, relating it back to things that we can all relate to. If you were going out to buy a car, and you said, okay, well, I've got 3 kids, so I need a 5-seater. I need space in the back for football practice. I need air conditioning. I want airbags. I'm not spending more than $50,000. It needs to be a 4-door. Or you have this list of criteria that you go out when you go to shop for this car. Do you come back with a $500 hunk of junk with no airbags, 30 years old, 2-seater? No, you don't, because you know what you're looking for. It has to meet those objectives in order for you to purchase it. And we need to develop the same shopping list as we would going for a car as we would do with a stock. That's the only way we can build consistency. So how do we do that? Well, let's firstly start by looking at what strategies work in the first place. And to do that, we need to understand what actually controls the market. So who controls the market? Any guesses? Who controls the market, everybody? Investors, okay. Any other ideas? Take a guess. Hedge funds? Yeah, possibly. Money managers? So who's familiar here with the term high-frequency trading? Who's familiar with that? A few people are. Yep. Feel free if you want. A lot of people are private messaging. You can also message in the main window if you like, or private messages, up to you. But okay, so a few people. Who isn't familiar with high-frequency trading? Who hasn't heard the term or been familiar with high-frequency trading before? A few people. Okay. So what we've actually got here is high-frequency trading is the most important thing to understand at the moment in today's market. Because who controls price is whoever controls volume. Volume dictates price. So who dictates volume? The smart money do. Let's just come back to that idea. Just remember, volume is very, very important because price can be deceiving on its own. Volume is one of the most important things because it can manipulate price. It tells you the truth about what price is actually doing. So understanding who has the power to, who it controls that volume is the key thing. So who controls the volume? The smart money does. The high-frequency trading smart money does. And the statistics on this, if you weren't aware of this, in fact, you can Google 60 Minutes high-frequency trading. It was a report done about 2 years ago, and maybe even longer actually now. And it actually reviewed and said that statistically speaking, 70 to 80% of every single stock bought and sold every day are being done by bots, as in computer programmed traders. There's no one sitting there watching the screen, no one making the decisions, no one reading the news. This is 80% of the trades being done because they're programmed using a pattern to buy when a price hits X and sell when it hits Y. I know it sounds hard to believe, but it's true. This was 2 years ago. I can only imagine it being higher now. And these bots are based on preset algorithmic functions, and billions of dollars a day go through these. And they don't care what the company does, who runs it, what the economy is doing. All it's doing is buying and selling, trying to push the stock up and down as many times in a day to make a lot of money. And some of these funds that trade this way, this is Goldman Sachs, JP Morgan, Knight Capital, are just a few of the main ones. These represent 70 to 80% of the volume, and some of these funds have made money 16, 17 months in a row without a losing month because they have such a high level of control and manipulation of what's going on. And if you want to look at the evidence of that, let's have a look at the flash crash in 2010. The flash crash in 2010, who remembers this? Anyone remember this, this scenario in the market? A few people, okay. So when this hit, this was when the market dropped 1,000 points and then went in half an hour and went straight back up as if nothing had happened. The only way that such a huge level of movement can happen is with a huge amount of selling. And how can that level, that massive amount of level, just hit some kind of magic floor and turn straight back around? Because it's pre-programmed. These areas where they buy and sell are programmed. They said that it was as a result of somebody pushing the fat finger complex, the B button instead of the M button. Whoops. Well, I highly doubt that. I don't know what the stock market takes us for. Kind of like just recently when there was a lot of weird volatility happening in the NASDAQ. 2 days before the NASDAQ got shut down, I had a string of my traders that I've taught in the years and traders who work with us at the Acorn office as coaches all said to me, I don't know what's going on, John, but it looks like there's different stocks and indexes flash crashing on the NASDAQ. There's different stocks and things just flash crashing. I can't figure out why. And I thought, isn't that interesting? And then the very next day, the NASDAQ got shut down. You remember that? And what did they tell us that time? They told us that someone tripped over the cord. Well, rubbish. That is the biggest load of garbage I've ever heard. And if you accept that, then you're doomed, because this is the news. This is the facade of the market to keep you thinking that it's not. There's something not a little bit more devious going on under the scenes, because there is. But the beauty about this is that these forces that control the market, these algorithms, it creates a problem. It creates a problem because investors say, well, nothing's changed about the stock that I own, but for some reason it's gone from 10 to 15 to 8 to 12. And there's a massive amount of volatility that leads you to just want to stick your head in the sand because you don't know exactly when to get in. You don't know when you should get out. The risk is hard to manage. It becomes a stressful endeavor rather than a money-making, exciting endeavor. So let's change the way we think about it. Let's look at what actually makes these moves happen. Because when you're controlling 70 to 80% of the trades in the market, you're using algorithms, computers that basically follow the same rules again and again, millions and millions of times over. And we can reverse engineer those things. So what we can do is we can take a computer algorithm and figure out how it makes its decisions, because it does it the same time again and again. Right? So like, for example, if you look at it this way, if 100 stores in your local area all got robbed tonight, and they looked at what was stolen, and what was stolen was red Reebok shoes. If you wanted to figure out where the thief was going to hit next, what would you look for? What would you go out there and look for? That's right, red Reeboks, exactly. So you'd be looking for where that common denominator, the common symptom, was hit. So when we go into to actually studying these things, we go and look at these trades that happen, and we take thousands and thousands of trades that have all done the same thing, that have gone up 10, 15% over a few days, and we look at what every single one of those had in common before it went up 15%. So literally, we've run millions and millions and millions of calculations comparing every single stock to each other, looking at all the possible things that were the same, until we find the common fingerprint that they all seem to have. What we then do is we then look at all of the stocks that looked the same but didn't go up. And we start to figure out what they all had in common. So you figure out what all the stocks that went up had in common and what all the ones that should have gone up but didn't have in common. And you start to develop a profile, which essentially is exactly what these high-frequency trading smart money is looking for. Now, just very quickly, before we go on to this, I know sometimes some people ask me, well, John, how does that mean that Goldman Sachs or JP Morgan therefore have 70 to 80% of the money? No, it doesn't. What it means is, for example, if there's 100 people in a room, each with $1,000, and they all buy a stock today with that $1,000 and hold it, that's 100 people, each who have $1,000, and they all go and buy the same stock today and hold it. How much volume does that create in the market? 100 people with $1,000. How much volume does that create? If they buy a stock, let's call it stock XYZ, and they buy it and they hold it. That's right, it creates $100,000. 100,000 volume. Okay? Now then, let's say I come along, and let's say I've only got $1,000 as well. Okay? So this is the group. And let's say this group is like the investment community. And then there's me. And let's say I'm the high-frequency trader. I've only got $1,000 as well, but what I do is I buy and sell in the same day. So I then equal, because I bought and sold, I now equate to $2,000 of volume. And then let's say I do that 100 times. So now, as one individual with $1,000, I represent $200,000 of volume instead of you as a group being 100 people with $1,000 each only representing half of that. So with 100th of the money of the group, I can create 200% more volume. Do you see the difference in that? That's a massive difference. So it's basically like death of 1,000 cuts. I can buy and sell, buy and sell, buy and sell, and whip the market into particular movements by having that level of high frequency. And that essentially is how only a few different firms create this level of manipulation. And in fact, when Knight Capital, which was one of these high-frequency trading outfits, got shut down for 2 days last year, I think it was 70%, I think it was roughly 70% of all of the future contracts traded on the New York Stock Exchange vanished from one firm being down. Now, so the reason I focus on talking about this so much is because when you understand that there is this amount of power behind computer automated rules, this is why technical analysis is so important from at least understanding it, but then incorporating it into your strategy, but doing it effectively. So not just following the stock market for dummy books and using your moving average and things. That stuff's fine, but that worked 10 years ago. That's not how the market works anymore, not effectively anyway. So the first things we have to understand is go back to basics. What moves the market? Well, the three things we need to understand is that a stock will not change direction, really, unless it hits one of these three things. Horizontal support and resistance, trend line resistance, which is a diagonal line, or a moving average. So when we actually, when the algorithms look at the market, the algorithms don't see this. Algorithms do not see a chart when they're trading stocks automatically. They see this. What the algorithms see is the preset levels that they are waiting to push the stock up to sell and wait for it to come back down to buy. The preset levels. So have a look at the flash crash of 2010. Here it is with the levels drawn on. This was the where the stock S&P 500 had rallied down to. It then hit 1060, shot, and from a fairly large drop from 1160 down to 1060, went straight up from here, and then found this little shelf, this little level it sat on top of, and then when it broke that, that was when all hell broke loose. And where did it come back to? It came back to exactly the same place that it had previously rallied from before. And when it bounced, where did it go to? Straight back to that level. And you can see that pattern continue playing out. So the first step that we need to do to understand how to build an effective trading strategy is understand how to find those levels. Because all the work you're currently doing, whether it's fundamental research, whether it's newsletters you're reading, or whether it's tips from friends, you could be right. You could be 100% right that that is the diamond in the rough and it is the best stock out there to buy. This could all be very valid. But you could buy the right stock at the wrong time, and that could mean all the difference in the world. Because if you buy the right stock at the wrong time, you'll never make any money. Because you could buy the wrong stock at the right time, something that's dropped from $100 down to 20. You could buy it at 20, sell it at 30, make 50%, and then the very next week it goes bankrupt. Wrong stock, great timing, and you make 50%. So I'm not saying that we want to do that. What I'm saying, though, is yes, let's still do our research. Let's still incorporate our whatever you're currently doing into your strategy. But wouldn't it be valuable to figure out when the money that actually makes the market move agrees with you? Wouldn't it actually make sense to figure out where they're going to buy? So how do we do that? Well, we'll come back to that. The first thing is to look for strong levels. We're looking for strong levels where we can see a massive reaction has happened before. So like the flash crash, if you see a stock crashing and it's going millions and millions and millions of shares a day, and then it hits some level and then just turns straight around and goes right back up. Think of it that way. If you have a Mack truck of 100 tons going 100 kilometers along a highway, and then it turns 180 degrees and goes straight back in the opposite direction with the exact same speed, that's a pretty incredible feat. Versus a Mack truck or a stock that comes down and slowly turns around. This is far more powerful than the one on the right. Excuse my scribble there. So the first step is we want to find where strong reactions have happened, because that tells us where the smart money has acted before. Because if the smart money didn't do that, people can't react that fast. So this is the symbol, the fingerprint of smart money buying or potentially smart money selling. So we look for strong levels. We also make sure that the level has only been hit once or twice maximum. So after it's hit once, maybe it comes down and does it again. The third time is the very last time that that level becomes useful. Because as soon as it's done it more than twice, more than 3 times, now it doesn't work anymore. Now, can anyone guess why? Why, and I'd like everyone just to have a guess. Why doesn't it work anymore after 2 or 3 times? Just everyone take a guess. You don't have to be right. There's no wrong answers here. That's right. Everyone knows it, so they change the algorithm. That's right. Everyone is buying there. You're all bang on. Now, if I can beg your patience for a second, I'd just like to explain how I explain this to my new investors. I know that we've probably got some experienced investors in here as well. So if I'm talking about stuff that you already know, thanks for sticking around and bearing with me. I want everyone to be on the same page, though, because this is the best way I can explain these algorithms. It was when I first came to the U.S., well, when I was living in the U.S., I was down in L.A., New York, and so forth for a few years. When I was down there, I went to go see my first football game, U.S. football game. I remember sitting there and watching, and I couldn't for the life of me figure out what the hell the game was about. And by the way, for those of you wondering, I was from Australia originally. So I'm watching this football game, quite different from how we play football over there, and it just looked like chaos to me. The ball comes out, gets thrown back to the quarterback. Quarterback starts running backwards while his other teammates are running forwards. That on its own threw me for a sec. So I go, what the hell is going on? They're running in different directions. And those guys, they're running up the left. These guys are running on the right. They don't have the ball, but they're tackling each other. This doesn't make any sense. And the more and more I watched it, the more I realized it wasn't just chaos. I thought it was. I thought this was just people running at each other, and then the guy's just going to throw the ball as far as he can. Hopefully someone breaks free and finds it. But it wasn't. It was a pattern. And what I watched more and more as I watched more games was that these same patterns would happen again. Hail Marys, different plays, and the players actually knew exactly where they were supposed to go and when they were meant to be there, even though it seemingly looked like chaos. But just so in the stock market, basically the smart money is the coach. The smart money is the coach, these algorithms. They want to manipulate the players around the board, being the stocks, so they can make money from it. Because what a great way to make money. Be able to push a stock down to 10 and buy it, push it back up to 20 and sell it, and do it again and again and again and again and again. That is a perfect way to make money. So manipulating the market is quite a fascinating thing to watch. The thing is that just like a football game, if the coach played the same play again and again and again, the other team would get wise to it. And it would, as you've said, stop working. And so the job is to keep switching up the play to make people still feel like it looks like chaos, and to continue making money. So this is why these things stop working. And I hope that was worth spending the time explaining that, because that's really useful if you think about these things in a way that is common in everyday life. So let me ask you now, I'm going to give you a bit of a test. And again, everyone have a shot at an answer here. Because after we go through this, I'm then going to show you the tools we use to start building scans and how to actually build a strategy. So again, the first step is finding the strong level. So given what I've just talked to you about here, let's say that you were looking at a stock. And this was what the chart looked like. Now what you do is you have a few options here. If you were to wait for a certain trade setup to occur, what would you wait for? Would you wait for this? Would you wait to short this stock here at A? Or would you wait for it to bounce up here and short this at B? Or would you wait for the stock, or would you buy it right now at C? Or would you wait for it to drop, hopefully, and buy it at D? And if you have a couple of answers, feel free to throw them up there. What does everyone think? Short at A, short at B, or buy at C, or buy at D? What do you think? I know we're going to get a diverse group of answers, because we always do with these questions in class. Excellent. So I can see buy at C, short at A, buy D, buy at C, buy at C. I would buy B, okay. Maybe you got a breakout there. Okay, so let's kind of look at where these, by the way, are all correct answers. There is no wrong answer. That's the beauty about trading. But the focus of tonight is about finding the perfect storm. So the objective of me as a trader isn't to be the best, smartest trader, to know the most information about the stock market, because arguably that doesn't necessarily help us make money. When we're looking for finding the perfect storm, the objective is to find the highest probability, the best way to make the most amount of money with the least amount of risk. So even though these are all valid ways to make money, these could all be winning trades. The question we want to be asking ourselves is, just because it's a possible trade doesn't mean we actually want to trade it. And let me give you an example of, before I give you the answer I would suggest here, let me give you the, an example of poker. Okay, in poker, can any hand win? Yes, any hand can win in poker. So you could win with a 2-3 offsuit. You could win with a 5-5. You could win with a queen and a 4. Any hand can win. Just ask one of our colleagues here, Kyle, at the office. He had ace-king suited in a big poker tournament recently and lost to a 5-3 offsuit. That's called a bad beat. So the reason I raise poker is because, yes, you can win with any hand, but does that mean you play every hand? No. That's almost the guaranteed method, the recipe for how to lose. The objective as a trader is to only, or a poker player is to trade only the high probability patterns. Only the high probability patterns. And that means waiting for the perfect hand, or in trading, the perfect storm. So when we start looking at this trade, here's what I would suggest to you as the answer. I would suggest the answer to this is actually to go long at D. And here's the reasons why. The reasons I would go long at D is because, firstly, let's ask ourselves, which was the most powerful level? Where did the biggest reaction happen? Well, at D, it hit here and went up 1, 2, 3 levels. Let's say each level represents 10%. That's a 30% rally. Massive movement. When it hit A, it only dropped 2 levels. So we got 20% potential profit by shorting there. Then we touch C, and C went up 1 level and did it again the second time. So when we're looking at levels, we want to, again, come back to that football example. Every time a level is hit, it becomes weaker. So every time it touches on C, this level becomes less and less powerful or less and less reliable. And now we're coming down to the third attempt, third touch. So it's still valid, and it still could quite likely make us 10%. But compared to the other levels, this one, D, is fresh, only hit once, and its power is 30. A only hit once, and its power is 20. Both B and C have already been tested twice, and there's much less significant moves. And I know that the instinct is to say, well, we want to buy them because they've hit, it's shown to work a couple times. But just remember, that's why investors lose money. Because what we intuitively think, the more times it touches, the better, is actually wrong. The more times it touches, the worse it is. Okay, now, of course, one might think, well, what if it never goes down to D, though, John? What if it never goes down to D? Then you wouldn't make any money. But that's okay. Again, the objective is not to trade every stock. The objective is to trade only the stocks that meet your criteria. Just like if you went out looking to buy that car, and the only car they had was not what you wanted. You don't buy it just because it's the best of the worst. You go to another store. And with the stock, as soon as you stop realizing that you can only trade companies that you're familiar with, and as soon as you stop thinking that you have to trade the company that you work for or that your friends told you about, as soon as you get unlocked from buying things because of your emotional and logical attachment to them and start buying them only because they meet your strategy, is the moment where you'll start making a lot more money as a trader. And just completely disengaging. As the old saying goes, it's just business, not personal. Okay, so that is where I would suggest. Now, here's the KPPs, Key Performance Indicators. Is that what we're talking about? And just remember, I'm not saying that, I'm not sure what you mean by KPPs, oh, pivot points, absolutely. Yeah, we can talk more about that, maybe at the end of the session. But yes, key pivot points work. So we have to establish, like, for example, Fibonacci extensions and retracements, pivot points on the day trading chart, open range, the first day of the month. I mean, you want to talk about pivot points. I'll just switch over to a chart real quickly. This might be interesting for you. I'm not sure how many people are aware of this, but when you start looking at, for example, key points that the market's turned, how many of you heard about the first day of the month and options expiration day of the month? How many people have talked about that before? Okay, so yeah, if you want to look at where the market has turned, I'm just going to show you here on the chart. Just take everything else off here. These are this is the S&P 500. I'm just going to show you the first day of the month and the options expiration day. So what you can actually see here these days I'm pointing out as the first day of the month and options expiration day. And you can see that a lot of these major turns in the market have actually been on these days where these lines are actually drawn. And there's right here, the most recent, there's options expiration right there, and that's where we broke this rising wedge. So understanding where the key pivot points are also very important. But this all starts from understanding that because I mentioned that these are several points that can be manipulated, and this is where it all begins. So the second thing, before we get further into that, have a look here. Here's another test for you. Out of these two different charts, if you had a choice, okay, if you had a choice between shorting this company here, company A, or shorting company B, which would you prefer? B, okay. Any other guesses? Okay, yep, B. Everyone's saying B. Good, great, because this is where we basically get a strong reversal. Strong, sharp reversal. That's what we're looking for. And we can see here that over here, as we talked about before, this is the slow-moving semi-truck. It slowly turns and then goes back up. So B is by far much stronger, Also because of the way it's reversed, but also because of the fact that A also has higher bottoms. So higher lows could be symboling that we're actually moving towards an ascending triangle, which would be a breakout. So understanding these types of things allows us to know the genes of what actually moves a stock. So once we've found these strong pivot points, we then now need to understand that the smart money is the key thing. So here's our checklist. In order to move the market, to change the direction, smart money has to agree. So let's find a good stock. But let's find a good stock where the smart money is about to step in. Because if then, no matter what, if the market makers are still selling, that stock's going to go further. So timing has to be right. Let's move forward. So what's our checklist? Our checklist for finding a smart money trade is we need to find stocks correlating with the market. Correlating trades with the market. So what I mean by that is we need to analyze the indexes at the beginning of each day, or right now, for example, tonight, for the next hour, when we finish our session, that's where I start my research to know what to do tomorrow. As a swing trader, I'll place all my trades for tomorrow, tonight. So my first step is to analyze the S&P, the Dow, and see where the indexes are at, and make a decision, are we bullish or bearish? So if I decide that we're bullish, my next step then is I need to go into my sectors, right? So I'm going to go into my sector watch list, and I can then scroll through easily the different sectors. So I can see that the consumer discretionaries, which was my bullish pick back on the 17th, is now at resistance. So it's right at the ceiling. Next, consumer staples, broken out severely, needs to pull back for a good risk-reward trade. So I wouldn't look there either. Energy. Now energy is heading towards a double top, but if it breaks through 88, that could be a breakout trade. So I'll look at energy as a particular place to focus timing-wise. Incidentally, if it hits this and reverses, it could be a good short or a double top. So energy will be a place to focus for my scans as well. The financials still trying to break out. So again, possible longs, looking like breakout trades. So we start to look at these sectors. Healthcare just broke out of its rising wedge. Okay, so we start to look at the sectors. Now I mentioned, so Sherry says, I thought you said we should focus on the big moves, not the short ones. Well, no, what we're looking for here is not to trade these. What we're looking for is correlation. So what I'm looking for is I'm trying to find out of all the sectors and markets, where is the most bullish or most bearish activity located. So something like healthcare has just broken out of its resistance. So it's got all this room to move up with its support right beneath it, versus, say, for example, consumer discretionaries, which are right at resistance. So they've got very little room to move before running into a problem. So out of the two, which is more bullish? The healthcare is more bullish from a sector-to-sector comparison. Now, I wouldn't trade any sector. I'm not interested in that because, as you said, these are not big moves. But what I would then maybe look at doing is if I feel, hypothesizing, that that the market is bullish, therefore I'm looking for bullish sectors. So then I might say, well, the healthcare sector is bullish. So therefore I'm going to be looking for big moves within the healthcare sector, for example. And then I go back to the rest of my checklist. So now I'm looking for stocks that have strong, high probability zones, so strong levels of buying, fresh levels, only hit once or twice, maximum, and powerful levels. So going through this checklist now, I've looked at the market, I've looked at the sectors, then I look for the individual stocks that are setting up for big, powerful moves. So an example of something like this, I'll just show you this. We'll look at something live on the chart here in a second. But here's an example of one of these with one of my favorites from last year. This stock, CBOE, it's the Chicago Board Options Exchange. So have a look here. This is what the type of trade I'm looking for. Stock rallied up. This is the options exchange, remember. So massive move up, ran straight into resistance here around $30 and went straight back down. That's the whole exchange completely turned on its heels. Straight up, straight down. That is a very powerful zone. So as soon as it came up and hit again, there was your second opportunity to short. Again, very similar reaction, straight down to that same price and then dropped even further. So this whole time I had an alert set up in my trading platform weeks before it even got here. As a swing trader, again, I don't want to have to ever need to watch the market during the day. If I do, it's just because I want to see what my stocks are doing. So as soon as we got to this price level, I knew that I had a position to take. I could have pre-programmed to do it for me, but I wanted to eyeball it. And then you see it, and we make our put in our entry right here at this price. And what happened next? Straight down again. And the target there was to start shorting here at 29.50 and get out at 28 and 27. Two different exits. That's the plan with that, based on that extreme price that it was at with all of those other factors kind of coming into play. So smart money checklist, all those things are checked off. In terms of volatility, yes, the stock has to have volatility. Because the very nature of what we're looking for, the stock has to be volatile if we're interested in an extremes trade. So we want to see that it's got the ability to move up and down 10% within a week. But we want to get in where we have a very high probability of success with a very minimal risk. So the type of trade, for example, is where I can risk 0.7% to make 8 or 9%, or one of the stocks I'm looking at right now, it's a 0.7% risk for a 7% reward. So for every one trade I make like that, it pays for 10 losers. So I can get it right 20% of the time and still make money with a strategy like that. That strategy, however, is more correct about 60, 70% of the time. So every winner pays for 10 losses, and you have 6 or 7 winners and only 3 losses, you're doing very well. That's the whole purpose of, yes, do we look for a move of 10%? Yeah, the average move that there's a few key strategies I use, and each has different results. There's we call it 3 Ps: profitability, predictability, and probability. So, and it's important that every strategy you do has concise, measurable ways of getting in or out. You must know exactly why the trade did well or why it didn't. So everyone should have a spreadsheet. One of the strategies I use has 18 columns. Price, how I spotted it, 5 different indicators I look for and what their levels were, volume, insider buying, market direction. I'll fill out every single one of my columns. And if one of those columns is bad, is red, I do not take the trade. Every column has to be neutral or perfect. Again, that perfect storm. And we'll go into some of those things that I look for here in a moment. But on a trading the extremes strategy, like I just showed you, my target would be 7 to 10% over a week on those types of trades. It never is much more than that. So on different trades, on momentum trades, for example, fallen angels, we're looking more for 10 to 16%. And that usually takes about 2 to 3 weeks. And that's more of a momentum trade. And then there's other strategies as well. But all of this comes back to having set methods of going about it. All right, so let's push forward. The next thing we can then look for to make this a higher probability is confirming using Bollinger Bands. So here we go. We've got a Bollinger Bands up on the screen. Who's used Bollinger Bands before? Anyone here use them, and how many people haven't? So yes or no? Great. Just while we're waiting for everyone else to answer, Sherry. Okay, so everyone who's used them before, how have you, I expect most people have used these in some form or fashion. How have you used them? Some people wait for the squeeze. Some people wait to go outside of the upper Bollinger to go long. Some people wait for it to go outside of the upper Bollinger to go short. How have the people who've used it in here looked? Usually it's one of those few things. Squeeze, squeeze, okay. So just a quick question to everybody then. If the stock goes outside of the upper Bollinger, what do you generally see that as being a sign of? Any guesses? Overbought. Get in or out. Okay, overbought. So generally if it goes outside of the upper Bollinger, you're expecting it to be a sell signal, I would imagine. Okay, excellent. Now here's the cool thing about these two strategies I'm going to talk to you about here. You can actually have the Bollinger, you can have a stock go outside of the upper Bollinger as a short signal, and it can also be a perfect long signal. And used correctly, the ingredient is very, very powerful. I'm going to talk to you more about this in a second. We won't be going much longer tonight, so those of you who have to get going, don't worry, we'll be there soon. But when you're building the perfect storm, it is all about looking at how the indicator is used. So, for example, it's like a recipe. Every ingredient when you're cooking something has a role to play. But depending on the recipe, it could be a very, very different role. And when you come down to technical analysis or strategies, every strategy has its own recipe. And what works well in one strategy might be terrible in another one. So we could say on one strategy it's a perfect buy, and then tell you that it's a terrible buy in another strategy and be absolutely wrong. So you need to know the context within which you're actually using it. Okay, just bear with me here. Okay, so let's push forward to the next slide. The final thing that when we actually confirm with indicators is then to finally look at the chart pattern. Now this is probably nothing new to everybody here, but it's also important that when we have everything perfectly aligned, so our indicators are saying the right thing, our price action is saying the right thing, all of those steps are actually all in play and working well, then we finally have to look at the chart pattern. And that will tell us exactly what the stock is doing. If it's indeed in a bearish pattern with everything else being bearish is ideal, obviously. The same thing goes for a long. But looking for all of those things to correlate will give us the highest probability result, which is what we're ultimately looking for. So in each of these patterns, we increase our probability, and then we confirm with all those indicators. So looking for the signs, as people have said in the chat window, of overbought, oversold, looking for heavy levels of volume to occur within those levels, and confirming using the Bollinger Bands. Okay, so let's put all that together. And you can see here, this is an example where CBOE, that same stock, was rallying up into that resistance. That's where it came up for the third attempt, went outside the Bollinger Band, and as it went outside the Bollinger Band, as people have indicated, that Bollinger Band therefore says it is a perfect short. The time frame, Sherry, I'm using on this is a 20-day Bollinger Band with a standard deviation of 2. Now, why I don't use Bollinger Bands for their squeeze. I know why they're valuable, but for this strategy, squeezes are unimportant. When we're looking for a stock to reverse, to be an excellent short, we are looking for a stock that is A, met a perfect, strong level of resistance. B, the smart money is getting out of it. So as the stock rallies up, money flow is going out. C, we're looking for it to be in a weak sector, in a weak market. Then we're looking for this stock, again, outside of the Bollinger Band, money flow coming out, and then we can use other oversold and overbought indicators like RSI and things like that, confirm with other indicators, as you've probably been taught to do. And the key then is to find when all of these happen, these things are happening at exactly the same time, right now. And here you can see that as the stock went in and it went outside its Bollinger Band into that perfect resistance, you can see the money flow on the bottom had dropped significantly. The price was much higher, but the money flow was not anywhere near the same levels as it was before, which created a perfect storm. And so the Bollinger Bands become useful now because, statistically speaking, 94% of the movement of a stock will happen inside the Bollingers. So when a stock gets outside the Bollingers, it has a 94% probability of going back inside right away. So when we combine these other factors, it makes it even more powerful. And that's how we start to get that high probability perfect storm, is by looking for when these factors all come into place. So let me show you now some of those recent stocks that have actually done exactly that. If we go over and I'll actually show you some of the stocks that have actually pulled up in our perfect scan, in our perfect storm. Have a look at this one. This one, for example, had appeared in our perfect storm strategy. Where was it? Here, 24th of October. On that day, our scanning tool told us that this was at the top, that it was a strong reversal potential. If you have a look, it was way outside of its Bollinger Band. It was coming up to look like it was going to create a lower high, so a double top potential, lower high. We go into some of our other indicators. We could see that the RSI was well oversold up into the 85 area. Our CCI was perfect, right above 200. So it was overbought, outside the Bollinger, overbought. Money flow, despite the stock rallying, the money flow was negative, divergent, which means money pulling out of the company. So everything we could possibly ask for, all saying this stock is due to drop. We've got a bearish close on the candle, and this was an easy short from 750 to, I think our target was 683. So that's a 10% drop in a day, not a week. And this was exactly the kind of thing that we look for. This was, in fact, what made this really cool was that this was the only stock that came up in our scan that night. We have about six different factors that scan the market every night. And in general, we will only find about 2, sometimes 3 maximum stocks that actually meet all the criteria in a day. It's very rare for them to find more than a couple of stocks that are perfect by those criteria. Okay, now I don't want to overwhelm you, but here is where, for those of you who, just one quick tidbit before we can finish up tonight, I want to show you when the Bollinger Band breaking out does not become an overbought signal. Have a look at this, and in that scenario, this is where you use the Bollinger Band being broken as a long. And those are when you're trading flags. So if you're trading a flag, here was our one that we picked in our flag scan last week. When you're trading a flag, it's the opposite. You want the stock to have gone up through its Bollinger Band. That is your buy signal to tell you to consider looking for an entry point. But the thing that changes it from a sell signal to a buy signal is money flow. So here, when we're trading a flag, this was something that came up in our scan and indicated us an entry at $2.40. Went outside the Bollinger, pulled back, there was the entry signal at 240 and gave us a target of just above 340, 350. And you can see that in the last few days it's actually rallied 30% and hit that intraday today. So, but this is a scenario where the Bollinger becomes a long signal. Again, a different type of application of the indicator, a different, same ingredient, but a different recipe. And that's why consistency and having a strategy is so important, because depending on what you're looking for, there is a very good set of tools you can use to find it in seconds by running a scan for it. So when you run a scan, you can spend your time analyzing 3 or 4 quality stocks and doing your research into them or analyzing the technicals versus wasting your time searching for companies that aren't even worth looking at in the first place. And so that's one of the things. If we do have a specific setup, and I've shared one with you tonight, looking for the extremes, how to identify those strong levels. So something you can start doing right away is running your scans, looking for stocks and identifying those key reversal levels. One of the stocks that we actually picked on the weekend, on Friday, sorry, for example, was Cash America. So we had our scan, looked for these strong, high probability areas, and you can see there's actually a 77% Fibonacci right at this price the stock had driven down to. Everything that we looked for was actually lined up. It was outside the bottom Bollinger Band, all those types of things, RSI, CCI. And we detected that the smart money was likely to have a buy somewhere around this 39 price because it had this huge rally that happened from here, from $38 to 54, started right here from this candle. Rallied up, consolidated, and then bang, just went. So we anticipated there would be likely another buy here as it pulled back down. So this was a very short day trade here from 38.50 up to 40 bucks, but just again a nice little kind of 4% profit. It might go further. So this is something you can start using right away and start incorporating into. Start looking for where these high probability areas are. We have a workshop coming up which will actually take you a step further, because again, I mean, whatever strategy you're going to follow, you need to have consistent variables, like a business. If you ran a business without a marketing strategy, a marketing plan, knowing what you were doing, how much money you were going to spend, what your ROI was, what's your risk, you need these things to run any kind of business, and you absolutely need them to run a portfolio. And you can't waver from them. You can't try a strategy and lose two times, then give up and try the next one and the next one. You have to go in with it to say, okay, I'm going to do 10 trades, and on every single trade of these 10, the indicators will all be what I'm looking for. RSI, CCI, money flow, stochastics, pivot points. You use the same set of criteria every time on every trade, and then out of 10 trades, if your risk reward is right and your strategy is valid, you should have made money. And then you do it 100,000 times. If you go and you do it 2 times and then you give up and do another strategy, you're never going to be consistent. And what's more, if you're not using consistent variables, you definitely won't be consistent. So Knowing what to look for allows you to scan for it. This is the big value of this is time. I don't spend longer than an hour any night on my portfolio, but it's something that I've done as a career. Been a career trader now for over 12 years. When you can make the same amount of money in 20 minutes, 30 minutes a night, as some day traders do, spending 6-7 hours a day, that's the key point you want to get to. Because when you know what you're going to do when a stock hits a certain price, and you know, based on your strategy, where you're going to sell it, and you know where your stop loss is because of your risk management, why sit around and watch it happen? It's like planting seeds and then watching the grass grow. Why do that? Let your strategy manage itself. That's what making money is all about. That's what being a businessman is about, or businesswoman. Let your money manage itself because the strategy is good. Something that we're putting on coming up, which may be of value to you, we're putting actually on a 2.5-hour workshop in a week and a half from now. That's what we were teaching earlier today, was the last workshop. And what we actually do is, obviously today's a great introduction, hopefully for you to see the concept of how to design scans and some of the variables you want to be thinking of, because you need to be thinking through what are your conditions, what are the triggers, and what the price levels need to be. And for every strategy, you'll have a different set of ingredients. In this workshop, we actually will be teaching you 3 different setups that we use every single day. So we'll be actually going in and teaching you how to, why basically as soon as you see a pattern, it stops working, and how to actually anticipate what a stock is going to do next versus what it's actually doing now. The differences between triggers and conditions when building the scan. Don't go broke on breakouts, learning how to avoid fake outs and capture the real movers. High probability, low risk trades. And what we'll be giving you is a discipline checklist that you can go through then and take these strategies away and know exactly what to be looking for from each indicator and be able to actually have the scans yourself. We'll give you those, and you can run them every night to actually find the stocks that we're trading. It's November 14th. It's on at 8 p.m. Eastern, same time as tonight. And it's very inexpensive. It's only $39. But it says 2 hours, but we usually go about 2.5 hours. It is actually part of our full-on course. It's one of the key modules that we teach in our Master Stock Trading platform. So it's actually normally a standalone module that we do sell for $499. I'm not sure if you've been aware of this or not, but we're doing a series of events at the moment for Acorn's 6-year birthday. And this is one of the launches we've been offering to people to really just kind of teach you these things so you can take them away and see how powerful they are. And, hopefully you'll be that impressed that sometime in the future, if you do want to take your education further, we'll be the people you think of. But this is a standalone module. You'll be able to go through it and actually start implementing and using those scans immediately afterwards. So this is actually an excellent way just to launch pad into strategies. It will be covering everything from, we'll be going through flags, we'll be using FinViz, teaching you how to build scans in FinViz, looking for optionable plays during earnings season. So things like eBay was a pick from that strategy last week, did 140% in 2 days. We'll be showing you how to find those high probability option plays. We'll be showing you flag formations, and we'll be showing you extreme trades. We'll be going through all the criteria we look for to identify the trade, and we'll be going through the actual scans on how to find them. So again, all you need to do to register for that is go to acornwealthcorp.com/up. I can promise you'll take away a lot of value from that. If you think of it, if you value your time at $50 an hour, and through giving you these scans, you save 1 hour a month, then the event's already paid for itself, just in your time saved alone. I think you'll find that with these things, you'll be able to save many more hours than that. Of course, the real objective is to make a higher return with less time or risk involved. So that's basically what's what's involved. It's a very kind of interactive session, and what we do is in the weeks leading up to it, so between now and then, we ask you to actually send in questions, different stocks that you are looking for, and then at the end of that session, we actually do a customization for every group where we'll actually go in and show you how to build scans custom to you, where we'll show you how to build algorithms, formula, indicators within free tools online. We use Incredible Charts, we use Metastock, we use Finviz, all these tools you can access, and we give them to you as part of the workshop. And we'll show you actually how to build your own scans as well, so that on top of learning our strategies, you can actually start implementing your own as well, and save yourself a hell of a lot of time. So again, that's acornwealthcorp.com/up. So there, before we finish up tonight, is there any questions? Thanks a lot, Sherry. I appreciate that. Yes, Thinkorswim. A few of the coaches do. I use Interactive Brokers myself, but our options trader, the gentleman I was mentioning earlier, the trader who's a full-time trader, he's actually a coach as well for us, and he uses only Thinkorswim. And see, he uses the TTM squeeze, and he has some very, very good option strategies and scans that he built in Thinkorswim. Yes, so we are very capable of building things within that platform as well. And what you can actually do with some of these tools is they can actually exist outside of your trading platform. So you might trade with Thinkorswim, but you can use, you know, this platform for finding the stocks. Is one way to go about it. Are we using high-frequency trading in your watch list? Sorry, I don't quite understand it. What we are looking for is the high probability moves. So when is the stock reaching that area where the high-frequency traders are likely to kick in? Okay. Are there any other questions? Okay. Well, we'll finish up there for the night. It's been wonderful having you all. Thank you so much for sharing your hour with us. I know we went a bit longer than we expected. I wanted to make sure we covered all the material, however. And, of course, I look forward to seeing. I see a lot of people have already registering now, so look forward to working with you all in the session on November 14th. Again, the session will be recorded, and you will, as a member of that session, be invited to any future sessions of that same event. We normally host that module. We start a new class every month, so that module does come around once a month, sometimes twice a month. So that will allow you many opportunities to attend live as many times as you want live. So you can revisit some of the techniques taught. So again, acornwealthcorp.com/up. If you have any questions, we're here. You can call us on 1-877-272-2676. Otherwise, have a great night and happy trading.